You were right about Nifty's direction. You bought a call option. The market moved your way. And yet, you still lost money. This happens to thousands of options traders every single expiry week. And today, we're going to explain exactly why. Welcome to Nifty Decoded. Today we're breaking down one of the most misunderstood concepts in options trading, IV crush. If you trade Nifty or Bank Nifty options, this concept could save you lakhs of rupees. Before we understand IV crush, we need to understand implied volatility. Implied volatility, or IV, is simply the market's expectation of how much a stock or index will move in the future. It is not based on past price action. When uncertainty is high, IV goes up. When uncertainty resolves, IV comes down. Think of it this way. On a normal sunny day, no one rushes to buy umbrellas. They're cheap. But the moment a storm is predicted, umbrella prices shoot up overnight. Options before a big event are exactly like those storm-priced umbrellas. You're paying a massive fear premium that disappears the moment the storm passes. So when does IV spike? Before every major market event. RBI policy announcements, the union budget, U.S. Federal Reserve meetings, quarterly results. In the days leading up to these events, implied volatility climbs, sometimes dramatically, making options very, very expensive. Let's look at real numbers. Say Nifty is at 24,000 before an RBI announcement. The ATM call option might be trading at around 280 rupees with an IV of 22%. Then the RBI announces their decision. Markets absorb the news. The next morning, that same call option is trading at just 165 rupees. But Nifty barely moved. So what happened? IV crashed from 22% to 11%. That is your answer. This is IV crush. The sudden, sharp drop in implied volatility immediately after a major event passes. Once the uncertainty is resolved, the fear premium evaporates almost instantly, and your options position bleeds value, regardless of which direction the market moved. Look at an IV chart around an RBI policy day. 5 days before, IV sits around 22%. The day before, it climbs to 28%. Peak fear pricing. Then the event passes. IV crashes to 14, then 11%. Any option buyer who entered during those 5 days paid for maximum uncertainty, and they got crushed. Here is what makes IV crush truly brutal. On budget day, say you bought a Nifty call option at 310 rupees. You were smart. Nifty actually rose 200 points in your direction, but IV crashed from 24% all the way down to 10%. Your option closed at just 185 rupees, a loss of 125 rupees per lot. You were right about the direction, and you still lost. That is IV crush in action. IV crush happens most predictably around specific events. Weekly expiry on Thursday. IV builds up during the week and collapses on expiry. RBI policy days. Budget day. U.S. Fed meetings. Quarterly results. In all these cases, the same pattern plays out. IV spike before the event. IV crash after. So how do you protect yourself? 3 strategies. First, don't buy naked options on event days. Wait for the IV to normalize after the event, then enter your trade. Second, use options spreads. A bull call spread limits your IV crush exposure because the short leg benefits from the same IV drop that hurts your long leg. Third, become the seller. Short straddles and strangles around events are how professional traders harvest the IV premium instead of losing to it. Here is the golden rule. If IV is above 20% and a big event is due tomorrow, you are not buying an option. You are donating money to a seller. Before every trade, check India VIX on TradingView. When VIX is elevated, lean towards selling strategies, not buying ones. Let's recap quickly. Implied volatility is the fear premium in options. Before events, IV spikes. Options become expensive. After events, IV crashes. That is IV crush. Option buyers lose even when direction is correct. Option sellers profit from the drop. Protect yourself with spreads, post-event entries, or short strategies. If this video helped you, please like and subscribe to Nifty Decoded. Next week, We're covering how to read the put-call ratio to predict Nifty's direction before placing any trade. Every week, one options concept broken down simply. See you in the next video.